Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, Peter Schiff. He, of course, is the CEO of Euro-Pacific Metals and also Euro-Pacific Investments up there in the Northeast. Peter Schiff, thank you so much for joining us today.
Thanks for having me on today.
Well, Peter, you know, you're out with a brand new article called the GDP Distraction, and it talks about GDP, and your analysis says that our gross domestic product is a lot smaller than what people are making out that it really is, and with some kind of analysis here that says it's, off by, maybe $3.5 trillion.
Well,
tell me about your GDP distraction, which distracts you, as you say in your article, from the truth.
Yeah, who knows how much it's actually off by. That's just if you assume that the government had used the CPI as the inflation measure rather than the GDP deflator. But I recognize that both the CPI and deflator are measuring different things. But the key is that if you look at the CPI and the deflator for about 40 years, ending in 1977, the rate of increase for both measures was virtually identical. But starting in 1977, there's been a growing gap between the deflator and the CPI, and the gap seems to get bigger and bigger with each passing year, where the CPI keeps growing faster than the deflator. Now, I think both measures are underestimating inflation. But what the government is using with the deflator is to try to correct the GDP for inflation. Because after all, if the economy is getting bigger because prices are higher, well, that's not any real economic growth. We're not better off. So they're trying to take inflation out of the GDP by factoring it with the deflator. But my argument, and what I point out in my piece, is that I think that number is just much too low. For example, the last GDP that we got, the preliminary estimate for the second quarter, the government assumed that inflation was running at an annualized pace of 0.7%. 0.7%. I mean, how could anybody take that seriously to think inflation is that low? But, of course, that's what they have to pretend in order to pretend the economy is growing.
Well, when I read your piece and you came up with 12.99 gross domestic product as opposed to 16.4, I'm thinking, your analysis says it's off by $3.4 trillion. I mean, this is off by a couple $100 billion.
I don't know how much
it's orders of magnitude, which tells me the debt to GDP, the all-important, what's your debt to GDP ratio, is a lot worse than what it is. How does that affect this debt ceiling negotiation coming up next month and the end of the fiscal year for the U.S. government? It's way worse than what the government is pretending it is.
Yeah, but a lot of it is, it's the nominal debt versus the nominal GDP. But if you want to look at the real picture, what's really happening in our GDP, I think that it's not nearly as large. In fact, even the alternate number that I throw out there, I think is overstating the true size of the U.S. economy in comparison to what it used to be. I mean, if you go back and look at, what it was like to be middle class in America, in the 20s, 30s, 40s, 50s, before the government really, just started to explode in size in the 60s. But, a middle-class American family consisted of the husband who worked. He had a stay-at-home wife. He probably had a full-time live-in housekeeper. He had several kids and didn't have a lot of debt. Right? And the family lived a pretty good life. Today, you have a household. You got both the husband and the wife in the workforce. They're struggling. They have lots of debt, credit card debt, auto debt, student loans, whatever they got. They can barely support their families. They don't have any kind of live-in help. I mean, the wife who has a job in the day has to come home and do all the housework by herself in the evening. I mean, the standard of living has gone down remarkably, despite all of the technology and all the other advancements that should have made our standard of living go up. The standard of living is coming down. Why is that? I think because the economy is not as productive as it used to be. We're a smaller economy in real terms. And I think if you look at just the recent data, the government keeps telling us the economy is getting bigger, but millions of Americans are leaving the workforce. We've got record numbers of people on food stamps and disability. Real wages are falling. Part-time jobs are replacing full-time jobs. How is that consistent with a growing economy? It's not. It's consistent with a contracting economy. In fact, we're even using less energy than we used 10 years ago, even though the population is much larger. So it just makes perfect sense to me that the economy is shrinking, yet the government is using these phony numbers to try to convince us that a shrinking economy is growing.
Well, my question then, what drove me, I just looked at this, an OMG moment is, we got 17 trillion in counting in the debt that, our cash debt balance, and you're saying it's around 13 trillion. Then this is what you said, I don't know, last year or months ago, whatever, that we are worse than Greece. Well, we are, by all accounts, by your analysis. I mean, our debt to GDP ratio is way higher than what they would admit to. And how does this affect our negotiations for this debt ceiling and going into even more debt?
Well, remember, again, the debt ceiling is the debt ceiling is not the GDP. The debt ceiling is just a number, right? We're just trying to compare the debt that we have to the size of the economy to give us an indication of our ability to service the debt or repay the debt. But I think, if you really look at debt to GDP, you can't just look at the 17 trillion or 16.7, what it is officially, but we know it's above that because we've been at that limit now for a month or two, and it hasn't gotten any higher, but we know the government is running debt. But the real ability to pay our debt is not, it's not just, first of all, it's not just that bonded debt. What about all the debt that, Fannie and Freddie guarantee, or that all the guaranteed student loans? That's debt. What about the unfunded liabilities in Social Security and Medicare? That's debt too. So all of that has to be looked at in the GDP. But then you've also got to strip out of the GDP all the fluff that we put in there. As I said, we're overstating the size of the GDP. So much of it is consumption, which is financed with borrowed money. So when interest rates go up, because the world realizes that we have too much debt relative to the size of our economy, consumers can't spend anymore, and now the economy collapses in size, and now the debt balloons relative to that collapsing economy. So this is a huge, huge crisis. The question is, when is it going to come to a head? I think it's a lot sooner than just about anybody thinks.
Well, I mean, right now they're negotiating they were coming to the end of the fiscal year for 2013. They have this debt ceiling ongoing debt ceiling. What about foreign countries? Aren't they just going to say, we don't want your dollars? You're just pumping them out. I mean, isn't that the crisis you're talking about?
Yeah, I mean, look, we know from the most recent statistics that came out that foreign demand for treasuries is waning, just as the Fed is pretending that it's about to taper its purchases. I read today that now the Federal Reserve now owns over $2 trillion worth of treasuries and about $1.3 trillion worth of government-insured mortgages. So they're the biggest holder, they're the biggest buyer. And, as foreigners pull away because they realize that we can't pay back the debt, all we can do is sell more debt to the Fed, which prints money to buy it, thus destroying the value of the currency that we're promising to pay our creditors back in. It's going to be harder and harder for the U.S. government to borrow money from abroad, which means the Fed is not going to be tapering. They're going to have to print even more money to buy the bonds that nobody else wants. And that means the inflation numbers are going to get bigger, and the government's going to have to lie even more to pretend that there's no inflation. And so they'll be able to try to convince us that the economy is still growing when I believe it's going to be imploding in a very severe depression.
Okay, so I know I'm going to try to peg you down on the when question because, who knows, a month, 3 months, 6 months, sooner than later, all right? But what does it look like to the average guy? Let's get down in the granular street level. You pull up to your local BP or Shell station, and you look at the price of gasoline, and what do you see?
Well, I think you're going to see higher and higher prices. You got oil prices now about $106 a barrel. They're trending up. And I think that trend is going to continue. I think we're going to take out the high of $150 a barrel maybe sometime next year. But it's not going to be because we have a strong economy where everybody's buying more gas. It's going to be despite the fact we have a much weaker economy where everybody is buying less gas. At least the Americans are going to be buying less gas. But maybe people in other countries are going to be buying more gas. But we're going to have to pay more for less. That's going to be what characterizes the U.S. economy. Pay more, get less. It's going to be a declining standard of living.
Same thing with food, I take it. You're going to be paying more and get less?
Absolutely. You know, a lot of Americans are going to have to change their eating habits because the food that they used to enjoy will be beyond their ability to afford. People are going to have to start trading down the food chain, buying cheaper quality products, and probably paying a lot more money for it.
Do you think that we could reach a point where we have another 2008 crisis? And it's not just one Lehman. I mean, Deutsche Bank was downgraded in the last month or so. Barclays Bank, another big bank in the UK, I know you know where these are, downgraded. You know, the Fed is asking for new stress tests to increase the capital levels. I mean, could we have another, 2008 crisis that's not one Lehman but 10 Lehmans in the future?
Well, look, we're going to have a crisis worse than 2008. It may be that we have massive bank failures because I believe the banks are in worse shape and more vulnerable to rising interest rates and mortgage defaults or government defaults than they were in 2008. So we could get a much bigger bank crisis in the future than we had in 2008. But what we might have, instead of having a bank crisis, because the government doesn't allow the events of 2008 to repeat because they keep monetizing all the debts. They keep printing so much money that nobody is in danger of default. Then we get something much worse, which might be more probable, which is runaway inflation, where we destroy the value of the dollar, prices skyrocket, and that's the kind of crisis that's going to hit Main Street much harder than Wall Street, or much harder than it was hit in 2008.
Could we have bail-ins? This is my last question for you. You know, there's a lot of talk of European Union. When this Cyprus thing first happened, oh, no, don't worry about it. This is not that. Well, now it looks like this is the model, that they are going to have bail-ins. And, the folks in Cyprus did pretty well if they had euros outside the system. To your point, why keep money in the bank? They're paying you 0.1% or whatever. Having gold, silver, having tangible assets, things that are paid for outside the system. My question is, are we going to have a bail-in, and how do normal Americans protect themselves?
If we're lucky, we'll get the bail-ins. The bail-ins are where the depositors are asked to take a haircut, where they don't get made whole based on a government guarantee or the perception of a guarantee. We might not be that fortunate. I don't know that our politicians have enough integrity for the bail-in. They might want to pretend that nobody has to lose anything by printing money for everybody. But I think in the inflationary scenario, the losses for depositors in terms of what they can buy with their deposits will be much greater than in a more honest bail-in type situation where you don't get all of your deposit, where you actually lose. Maybe you have $100,000 at the bank and you only get $90,000 out, right? That's a loss of $10,000. But if the government makes it so that you don't lose any of your $100,000, but prices double, well, now your $100,000 feels like $50,000. You'd have been better off getting $90,000. But I think the inflationary outcome is what's more probable in America, and that's what I'm positioning for.
Peter Schiff, you are the CEO of Euro Pacific Metals, Euro Pacific Capital. Thank you for coming on and talking about your new article, the GDP Distraction, which distracts you from the truth. Thank you very much, Peter Schiff, for joining us on USAWatchdog.com.
Again, thanks for having me on your program.